Hey traders, this is Blake Morrow with Trader Summit, and it's Friday, and I have Mr. Jim Welsh with us. And by the way, if you like what Jim does here every week, guides you through the markets, make sure you give him a thumbs up right now and subscribe to this channel down below so you don't miss this any of this exclusive content that we do here on the Trader Summit. Jim, welcome back.
Great to be here.
You look between. Well, we had a bunch of central banks this week. We had the Fed. We're going to talk all about that. We had the ECB. I have to say, we probably won't discuss the ECB a whole lot, but Christine Lagarde sound pretty downbeat. You had the BOJ last night or this morning if you're in Asia. All of this, and here we are the next week. The S&P is 50 handles higher. It's not like we're flying higher, but we're still higher than we were last Friday at this time. So what gives? Why are stocks continuing to rally here?
Well, the main thing that has supported the market is the fact that a year ago, coming into 2023, people thought there was going to be a recession. And, it's like, oh, wow, we're not going to have a recession. And that has caused a shift in terms of people being underinvested in anticipation of that outcome to, oops, I got to get invested. And obviously the regional bank crisis added to that idea. And so what we've seen is, oh, wait, we're not going to have a recession. And the data that came in this week was, I think, very supportive of that narrative. My expectation in the weekly technical review was that we were likely to see Powell say everything he said, all right, but that the S&P would had the potential of popping above 4,600. And I thought the market would rally on Friday, today, because of the PCE dropping. So you have this narrative that we're going to get no recession, and yet inflation's coming down. And that is, there's no question that is what has been happening. As you and I have talked, to me, it's the second half of this year that will be the test.
So if we're not going to get a recession, the Fed kind of acknowledged this week we're not going to get a recession this next year, and it probably is not going to happen. Well, that also means that we're not going to get rate cuts next year as the market prices in rate cuts, and that's one of the catalysts for driving the stock market higher.
Yeah, I mean, it's out there, not as much as it was 4 months ago when people were looking for rate cuts to start this month. Remember? Back in April, I mean, that's what the thought. You look at the Fed funds futures. So again, I think the market just wants to believe that the economy is not going to have any kind of meaningful slowdown. Earnings are going to trough in the second quarter and then go up by 10 to 11% over the next few quarters. So that's the bar, and something has to come along to challenge it. I continue to believe that as we get deeper into the second half of this year, that in the third quarter, we'll see some signs of things slowing that will then accelerate in the fourth quarter. So we've got this window of time where right now everything looks absolutely perfect. And how long can that last? And as long as it lasts, the market is telling us that it wants to go up.
Yeah, it sure does. I guess the glass is always half full in the markets. And right now, this is the Goldilocks period, right? Inflation comes down.
Yep.
Job market's still strong. Looks like we're going to skirt a recession, maybe not even have one. Everything looks good, right, as we go into the second half of the year, as far as the market's concerned.
Actually, yeah, that's exactly where it is. So, you and I have been talking for months. First half of this year should be okay. Then we get into where a lot of these longer-term recession indicators, if you look at average lead times, like the yield curve is 19 months, LEI is 10 months, lending standards, 9 to 12 months. They all start to, if you will, reach their critical average lead time zone September to the end of the year. So that to me is like, okay, that's when the market will start to face a test. We're already seeing signs of delinquencies on car loans ramping higher, credit cards ramping higher. So there's stresses building. Bankruptcies so far this year, corporate bankruptcies are up very significantly. And yet the spread between high yield bonds and treasuries has continued to narrow. So, there's data points out there that say, wait a second, things may be not as strong as it appears on the surface. But right now, as long as the surface data points like GDP are positive, the market is just going to accept that at face value, and that's where we're at.
Okay, well, let's you got a lot of charts that we need to go through today.
Yep.
So let's get to them. The first one that we see here is growing twice as fast as FOMC projected GDP.
Yep. So what the FOMC does is they project targets for GDP, unemployment, Fed funds rate, so on and so forth. So they were looking for GDP to slow to 1%. So far in the first half of this year, it's north of 2%. The first quarter was at 2%. So the one thing I'll point out is consumption dropped from 4.2% to a 1.6% gain in the second quarter. That slowdown in consumer spending was offset by a big increase of business investment, which had been weak the prior 2 months. So that is a positive. Will it be repeated? Probably not. But for right now, it looks pretty good. The other thing, and I go into this in the August macro tides that'll be coming out soon, is auto production was assumed in a sense to be up at a 40% annual rate in the second quarter as automakers were able to ramp up production. They finally got more computer chips. That added 51 basis points to the GDP report. Inventories have increased by over 70% in the last year. As you and I mentioned last week, the auto loan rejection rate went from 9% in February to 14% in June. My point being is the second quarter GDP got a nice boost from auto manufacturing and production that isn't going to get repeated, even if sales stayed kind of at a level pace. I think potentially with auto loan rates going up, and I think lending standards are going to tighten more because auto loan delinquencies are ramping higher, that we're just going to, at some point in time, we're going to see auto production cut. But, for right now, do you think anybody who wants to be bullish and saw the 2.4% GDP print, are they going to take a deep dive and look at transportation equipment and autos assemblies? I doubt it.
No, they just went out to have a beer. So there you go.
Amen.
All right. So the next chart you brought up is fund managers recession. So explain what this actually means.
Okay. Bank of America asks a bunch of fund managers who manage a bunch of money what their outlook is for the economy. In last October, 60 or 73% or 72% were looking for a recession to begin in the next 12 months. So this goes to what I said at the outlook. You had so many people thinking there was going to be a recession. As you know, we discussed it a lot. Didn't think there was going to be a recession last year or in the first half of this year. Well, we've seen a complete turnaround. Now, in July, 68% don't think there's going to be a recession. Talk about a 180.
Right.
So
I mean, now we got the exact, you had everybody on one side of the boat last year, and now everybody's on one side of the boat this year.
Yeah. Now, if the economy doesn't really slow down in a meaningful way, all the things I'm talking about are kind of mute. I don't obviously believe that's going to be the case, but this just shows the shift in psychology, sentiment, and of course, then positioning in markets. In other words, underinvested last year because people were worried about a recession to being fully invested at this point. And maybe the next chart, I can't remember the order.
National Association of Investment Advisors.
Yeah. So this is another survey that looks, various investment advisors report what their investment position is. It's a 2-week moving average. So what we can see is in November of 2021, it was up to about 103%. Well, this past week it hit at 101.8%. The bottom half you can see is the S&P. So again, this just shows that as the markets improve, we've seen a big shift of money, going. Last October, this number was less than 20% invested. So it's gone from being less than 20% to over 100%. So again, does this mean the market has to fall? No, there has to be a reason to sell. And what we saw, obviously, as we went into 2022, it was the Fed rate increases and all the rest of that. So unless a reason to sell appears, I think that reason is likely to be a market slowing in the economy in coming months. The market won't go down unless selling pressure increases. It's just that simple. But this data to me, Blake, suggests that the market is, getting toppy. It's just, now, is it going to be a 5 to 7% pullback or something much deeper? That'll be dependent on how the economy performs in the next 6 months. We'll see.
All right. Well, that is really interesting because it's just, again, it's a really classic case of everybody's on one side of the boat, and when everybody gets on one side of the boat, you tend to see a
reaction.
Yeah, a lot of reversal action around there. Okay, so this is interesting. Stocks relative to bonds highest since November 2021. And explain this to me, because it doesn't make sense to a lot of people that have been in the markets for decades.
Yeah, what Longview Economic is doing, and that's the folks who put this chart together, is comparing the relative strength of equities to bonds using the S&P 500, and I'm assuming they also use the treasury yields. I can't read the fine print at the bottom there. Anyway, so the point being is when markets get so risk on relative to treasury yields, you're near a high. Now, again, November 2021 is when the Russell 2000 topped. It's when the NASDAQ 100 topped. The S&P waited about 5 weeks later to top in the first few days of January of 2022. What we can also see is the upper horizontal line is where the rallies peaked in the course of last year. So again, my only point is saying, listen, the news is affirming the narrative that we're not going to have a recession, and the Fed's almost done. We don't have to worry about earnings getting hit. And these indicators are suggesting that even if that outcome unfolds, that there's more risk, I think, than reward in the very short term in terms of the market. So that's the point of the last two charts. Positioning has gone from being very under invested to over invested or fully invested at this point in time. And relative to bonds, the market's vulnerable. It's interesting, Blake, yesterday we saw 10-year treasury yields tick above 4%. Some of that was driven, I guess, on a news report out of, that Japan was going to change their yield curve control.
Yep.
And treasury yields got hammered pretty hard, which immediately caused the equity market to reverse. And I think the next chart might be the 10-year treasury.
The next chart is actually the advanced decline line.
Okay, great. Okay, we're talking about stock market. Okay, we'll get to the 10-year treasury. All right. So trying to, again, keep it real, keep it honest. To me, one of the things I look at a lot is the advanced decline line because it shows broad participation. So back in April and May, I thought the S&P would rally above 4,200. But yet at the same time, the advanced decline line really was kind of sputtering. So what we've seen is that blue horizontal line marked prior peaks going back to the last 12 months in the S&P, and the advanced decline line, which is just the running total of how many stocks went up today minus how many stocks went down, has broken above those highs. Well, that's positive. It is what it is. So longer term, that's constructive. The other thing is you can see the advanced decline line has made higher lows. And finally, now we got this breakout. So that to me has to be regarded as bullish. It doesn't negate that the potential that there's a pullback coming, but it has to be looked at as positive. So I'm trying to keep an open mind. My view is that the market was going to be vulnerable to a pretty good sized decline if the economy slows as I think it will. It's possible that this is just that, we're just pushing out, instead of it slowing sooner rather than it's slowing a little later than sooner.
Yeah.
And this would then allow the market to have a correction and then ramp again. So I'm just trying to keep an open mind that, all right, as long as the economy holds together, there isn't a reason to sell other than, short-term news things, which, hey, a 5% correction, is kind of garden variety.
Well,
So,
before we get into the technicals, Jim, why don't you tell everybody how they can follow you and your work, and then we're going to get into the technicals.
okay, macrotides.com, or if you'd like to see a recent issue, like this last Monday's weekly technical review covered a lot of good stuff, I think, Jim Welsh Macro at Gmail, and I'll send you a recent issue.
And remember, if you're a Traders Summit viewer, make sure you mention that in his email, and he can give you a discount, right, Jim?
20%.
All right, let's get back into the charts. Yeah, that's a healthy one. Let's get back into the charts and let's talk about technicals here, because you thought last week that we might be near a top in the S&P, but we continue to grind higher.
Well, as I said in the Monday weekly technical review, to me, just looking at what was coming this week, to me, it was set up that, okay, a spike above 4,600, is maybe likely almost, just given the way the market's been behaving. We got the S&P jumped to 4607 on Wednesday before reversing, or not, was that yesterday? I think it was yesterday. Time flies.
It was actually on Wednesday, and we're not too far off of those levels going into the end of the week, but we continue to hold.
Yeah. And so the things I pointed out is you need to see momentum roll over. In other words, there's a lot of reasons to expect a correction, but until the momentum actually reverses, you have to respect the upside. And two things, the red moving average in the S&P chart is a 5-day exponential. The green is a 13-period exponential. I think here you need to see the S&P closed below the intraday low yesterday, which I think was 45.28. So I have 45.25. The oscillator that I use to determine how overbought or oversold the market is, you can see it's starting to weaken a little bit, but it hasn't given up the ghost. So to me, I would like to see the S&P close below 45.25, and then see that oscillator break below the lower of the two lines that are on the bottom part of that chart. So again, I think the table is set for a pullback, but until the market reverses, you have to respect the upside.
All right. Well, we're going to respect the upside, but at the same time, we are going to take a look at yields and explain to us what we got here in the bond market, because bonds still look pretty weak.
Yeah, I mean, again, what we saw yesterday, and again, this was driven in part by news coming out of Japan that didn't turn out to be quite as horrific as people maybe initially thought, in terms of, oh, gee whiz, if they do that, it's going to cut down on Japanese purchases of treasuries. That's kind of what led to that spike. We saw how the market reversed yesterday when the 10-year got above 4%. So that's kind of a key level. It's gotten below that so far today. But just looking at this chart, Blake, you can see, okay, the 10-year was in a downtrend, and then we broke above it, came down, tried to, if you will, reestablish the downtrend between the red and the green lines, and was rejected, and popped up. So to me, this chart looks like the path of least resistance is for the 10-year to get back above 409. So if, in fact, Treasury yields tick higher, and the 10-year gets above 4 and obviously gets above 409, I think the equity market is going to react, like we saw yesterday, negatively to that. So that trend line, that red trend line, is kind of key. If Treasury yields come down and get below that red trend line, that I think would be definitely bullish for the bond market.
All right. Well, we've been talking about the dollar, and the dollar looks like I think we mentioned this last week, but I'll just re-mention it. It looks like we might have gotten a false breakdown, but more importantly, there's a big long-term 618 retracement down here just below 100. And we got so damn close, Jim. And I'll tell you, the dollar's not looking horrible.
No. Again, to me, looking at like a 30 or 60 minute chart, Blake, from the low at 99.57, you can see 5 waves up. You can kind of see it on the daily, but it's more apparent on the intraday chart. That implies that, okay, up at a minimum, a pullback, there will be another move higher. I think the dollar has the potential to push up towards the 104 level. And again, the assumption here is that the Fed going to be one and done. And the data points that the Fed is looking for haven't really come in. And I'll keep going back to the labor market. For them to have high degree of confidence that inflation not only is going to come down because we're unwinding some of the inflation from a year ago, but then stay down. I think they want to see the unemployment rate get above 4%. They're projecting 4.5%. So the point being is that I think in speeches, we're going to hear a lot of the FOMC members talk about, that aspect to some extent. It's careful. They have to be careful because politically talking about an increase in the unemployment rate is like putting a target on you, for Elizabeth Warren and other people, understandably. But anyway, what the chart implies to me is that the dollar is likely to push higher in the near term. Once it gets to that 104, 104.50 level, that to me is the make or break level. It gets above 104.50, and now all of a sudden, I think the chart becomes even more bullish. But near term, a move back up to the 104, 104.50 seems, I think, relatively likely. If that happens, again, it's going to be because perception of monetary policy isn't as dovish. I mean, initially, the dollar sold off on Wednesday. Then we got data points yesterday. Whoops, wait a second. So again, just the chart analysis suggests I think the dollar is going to move higher in the near term.
All right. Well, the last chart that you brought is gold. And so what are you making of gold here? I mean, seems really sideways to me, Jim.
Yeah, it is, and it has been. The expectation was in early May that there was going to be a pullback. The bullish aspect was from the September low of last year. You got 1, 2, 3, 4, 5 up. So in other words, the major trend in my mind is up in gold. We were going to have a wave 2 pullback. The 382 is around 1892. I think it got to 1894. So the last few weeks, it's like, okay, we're going to get this bounce. I think we're going to have another drop down below that 1894 level, and that will complete wave 2 correction. And then I think gold is going to take off to the upside. So I'm trying to fine tune this because ultimately I think gold is going to go to a new all-time high. I think 2,400 is within the realm of possibilities, but near term, I just think potentially there may be a little bit more strength in the next day or two. But I think the odds probability-wise suggest a drop below the 1894. And then I think it'll be time to get pretty bullish on gold.
All right, Jim. Well, hey, I want to say I appreciate your guidance, throughout all the time. And I know people at home do as well. If you do, make sure you give Jim a big thumbs up. Thank him, and jump in the comments too. If there's something that's not quite resonating with you, jump in those comments. And I think Jim's been in the comments too, responding back to you as well. So, Jim, I want to wish you a great weekend, and hope you have a great week next week. And thank you so much for your time.
Hey, thanks, Blake. All the good wishes to you as well.
Thank you very much. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.